Okay, the last section for Chapter 7 is financing with receivables. And financial institutions, they've developed some ways in which companies can use their receivables to obtain cash. A couple of ways down below here are a secured borrowing and a sale of receivables. And we'll go through transactions describing both of those. First off, to define what the secured borrowing is the transferor or the company, the borrower, simply acts like it's borrowed money from the transferee, the lender. The receivables will still stay on the company or the transferor's balance sheet and will serve as collateral for the loan. The transferee will recognize a note receivable, so that transferee is the financial institution. The second way is sale of receivables. In this approach, the transferor, the company, or the seller de-recognizes or takes the receivables off its balance sheet, acting like it has sold them to the transferee, the buyer. The transferee recognizes the receivables as assets on their balance sheet and measures them at the fair value. So let's go through the first option there above, the secured borrowing approach. And with this, the entire receivables balance may serve as collateral. The arrangement for this secured borrowing should be disclosed in a footnote to the financial statements. You'll see an illustration of a footnote for Verco Manufacturing Corporation in illustration 7-13. The financing arrangements may alternatively be in the form of an assignment, where the company may assign particular receivables to serve as collateral for loans. If there is any non-payment of the debt, the financing institution can use those assigned receivables to go directly toward repayment of the debt. The lender will typically lend an amount of money that is less than the receivables assigned by the borrower. This is for the protection of the lender in that situation, so that if there is any uncollectability of the receivables, then the lender isn't loaned out at 100% of those receivables. Now, the receivables can be collected either by the company that is seeking cash or the lender. The company that is seeking cash is the borrower in this situation, and that will depend upon the details of the arrangement of who collects the receivables in the particular situation. Illustration 7-14 provides us an example for the assignment of accounts receivable. December 1, 2016, Santa Teresa Glass Company borrowed $500,000 from a bank. They signed a promissory note. The interest is 12% payable monthly. The company assigned, Santa Teresa assigned $620,000 of its receivables as collateral for the loan. The bank charges a finance fee equal to 1.5% of the accounts receivable assigned. So, initially, Santa Teresa records the borrowing as follows. They will credit the liability financing arrangement for the $500,000 that they borrowed. That is a liability on the balance sheet. They will debit the finance charge. This is an expense that will go to the income statement. It's 1.5% of the entire balance of receivables that were assigned, $620,000. So 1.5% of $620,000 is $9,300 that gets expensed. That is a fee to the bank. The difference between the two is the amount of cash that Santa Teresa gets, and that difference is $490,700. Now, Santa Teresa will continue to collect receivables in this situation. They'll record any discounts, sales returns, or bad debt write-offs and they'll remit cash to the bank on a monthly basis. So, for example, if $400,000 of the receivables that Santa Teresa is trying to collect is paid in December, then Santa Teresa will make the following entries for December. They'll debit their cash from the customers that are paying them, $400,000, and they'll credit accounts receivable for the same amount, $400,000. They'll turn right around and send that money to the bank. They'll send actually $405,000 because they're not only remitting the accounts receivable that they were paid, but they're also paying the interest expense. And the interest expense is calculated at the $500,000 amount that they had borrowed from the bank, times 12%, which is payable monthly, times 1 month out of 12 months, or the fraction 1/12, and that calculates out to $5,000 in interest expense. That is an expense account on the income statement. So the total amount is the $400,000 of cash received from the customer's account, plus the $5,000 interest expense equals $405,000 in cash that they will remit to the bank. We see some T accounts here that show the balances of the accounts receivable and notes payable counts on the balance sheet. And in the E edition, this red amount should be $220,000, not $22,000. It is shown correctly in the textbook, however. You see the $620,000 of accounts receivable. The $400,000 credit was made during the month of December, and that should leave a $220,000 debit balance. The note payable, the amount they borrowed from the bank, was $500,000. They paid back $400,000 of that principal in December from the cash receipts that they got from their customers, and that ended up leaving a $100,000 balance at the end of December. So the December 31st balance sheet for the company shows the $220,000 of accounts receivable that is assigned, less the financing amount that they have left paid to the bank, $100,000. So the equity in their accounts receivable that is assigned is $120,000. And when a company assigns a particular accounts receivable as collateral for the debt, the balances of those receivables and the debt are offset in the balance sheet as shown. Santa Teresa's financial statement should include a disclosure note that explains this situation with the borrowing from the bank. Now, the other method that we talked about above of the two methods is the sale of receivables. And here the seller, which is the company, the transferor, is going to first remove from the accounts the receivables and any allowance of bad debts associated with them. So they'll take those off the balance sheet. And the second thing, they're going to recognize at fair value any assets acquired or liabilities assumed by the seller in the transaction. And the third thing, they're going to record any difference as a gain or loss. Now, some companies that do this are listed here below. You'll see General Motors, Deere & Company, Bank of America, and two of the most common types of sale arrangements that we'll talk about here in the chapter are factoring and securitization. Now, in a factoring arrangement, the company will sell its accounts receivables to a financial institution such as a factoring company that will be in business to buy receivables at discounts. Now, that financial institution will buy those receivables for cash, and then they'll handle the billing and collection of the receivables and charge a fee for this service. Companies that like Visa and MasterCard are forms of factoring arrangements. And those are type of situations that probably all of us have used at some time or another with a Visa or MasterCard. But those types of cards are part of a factoring arrangement. We pay Visa and MasterCard, hopefully at the end of the month so that we don't incur any interest. When we used our card to make purchases, for example, at Walmart, Walmart is getting instant credit from Visa or MasterCard, and then they'll actually get their accounts settled within a couple of 3 days from those companies, and that frees up the cash for Walmart in that situation. Illustration 7-15 shows the advertising of a factoring service. And this one happens to be businesscash.com. So you could check that website out if you were interested in how their terms work. But you can see the advertisement there that talks about the cash that is freed up immediately by selling your invoices rather than waiting 30 to 60 days for your customers to pay you. And that how much they will advance you, how much businesscash.com will advance you, anywhere from 75 to 90% of the receivables that you have generated. And the fee that typically is anywhere between 2 and 4% when the invoice is paid. This next paragraph explains a little bit of that footnote that I just mentioned. Another type of arrangement that will be used in selling receivables is called securitization. And in this type of situation, a company will create an SPE or special purpose entity. And this SPE will buy a pool of trade receivables, credit card receivables, or loans from the company, and then it will sell related securities, typically debt, such as bonds or commercial paper, that are backed by those receivables. So as I've mentioned before, anytime you've got a company dealing with commercial paper and also bonds, you generally have a fairly good-sized corporation from a financial position. You'll see here in illustration 7-16 a description of a securitization program for Flextronics International and how that particular securitization process works for that company. Now, the specifics of sale accounting vary depending on the arrangement between the buyer and the seller. Now, what's dependent upon is whether the receivables are transferred without recourse, which means the buyer cannot come back against the seller, or with recourse, which is the opposite of that. The buyer can come back against the seller in case of bad debts. So here we're going to have sale without recourse, and in that situation the buyer will assume the risk of bad debts. And we see in illustration 7-17 we have some accounts receivable factored without recourse. And again, we have the Santa Teresa Glass Company. They factored some accounts receivable that had a book value on their books of $600,000, so they had $600,000 on their balance sheet, and they're factoring them to Factor Bank. The transfer was made without recourse. So in this arrangement, Santa Teresa transfers $600,000 of receivables to Factor. Factor is going to send Santa Teresa 90% of the factored amount, or $540,000. The factor is going to retain that remaining 10% to cover its fee, 4%, and that fee of 4% will equate to $24,000. And it will give it a cushion against any potential sales returns and allowances. Now, after Factor has collected cash equal to the amount that they have advanced to Santa Teresa, the $540,000, then Factor will remit any excess to Santa Teresa. Therefore, Santa Teresa, the arrangement Factor provides Santa Teresa with cash up front in this transfer of receivables equal to fair value of the last 10% of the receivables to be collected, less the 4% Factor fee. Now, before we go through the journal entries in the amounts, I want to go through my note that I made over here to the right-hand side of this illustration to kind of give you the side calculation of how the loss on this transfer is going to be calculated. So initially, we take the $600,000 of receivables that have been factored, and we're going to subtract off the $540,000 cash advance. That leaves $60,000. From this $60,000, we're going to subtract $50,000, which is management's estimate of the remaining fair value of the remaining 10% of the accounts receivable. And that's mentioned down here. Management estimates the remaining 10% of the receivables to have a fair value equal to $50,000. So we subtract off that $50,000 of the fair value, and that equals a $10,000 estimated loss. we're going to take that $10,000 estimated loss and add it to the $24,000 factoring fee that's based off of the 4%. And when you add those two amounts together, you get the $34,000 loss on the sale. And that's the second journal entry you see here that shows how to calculate the $34,000 loss. The rest of the numbers fairly drop into place fairly easily. We'll do the debit to cash. That's 90% of the $600,000, and that's $540,000, as we were told in the 5th line of the narrative. The $600,000 credit to accounts receivable, that's the book value of the accounts receivables that's sold. And then the receivable from the factor, $26,000, that's the $50,000 fair value that was estimated, minus the $24,000 fee that we calculate up here at 4%. So that's the $26,000 that's receivable from the factor. Now, the buyer is assuming the risk when it's sold without recourse. Now, the fair value, that $50,000 or the last 10% of the receivables to be collected, those last receivables to be collected are likely to be reduced by sales, returns, allowances, and that's why they have a lower fair value. So the other type of way that it can be sold is a sale with recourse. And with recourse, the seller retains all the risk of the bad debts. And to compensate the seller for retaining that risk, the buyer usually charges a lower factoring fee when the receivables are sold with recourse. So in illustration 717, if those receivables were sold with recourse, the only difference is, in our journal entries here below, is that Santa Teresa has to record the estimated fair value of its recourse obligation as a liability. And this right here in the e-text, it says without right here underneath illustration 718. That's incorrect. It should say, as I have over in my note, with recourse. And it is correct in the textbook, by the way. So the only difference that we see here in this 7-18 is they've upped the loss on the receivables by $5,000 to $39,000, and they've added this credit for recourse liability for $5,000. Other than that, the other line items are the same. Now, if that recourse, that $5,000 recourse, if the factor eventually collects all of those receivables, then Santa Teresa will simply eliminate that recourse liability $5,000 entry and would recognize a gain at that point in time. The next section talks about the transfer of notes receivables, and we'll handle the transfer of notes receivables very similar to how we handle transfers of accounts receivables. When you transfer a note to a financial institution, it's called discounting, and the institution will accept that note and give the seller cash equal to the maturity value of the note reduced by the discount. In illustration 7-19, we're going to continue on with the Stridewell Shoe Company, and they sold some land in exchange for a 9-month 10% note. The note requires a payment of $200,000 plus interest on September 30th, 2017, 9 months later. The company's fiscal year ended December 31st. The 10% rate properly reflects the time value of money for this type of note. 3 months after that note was done, on December 31, 2016, Stridewell discounted the note on March 31st, 2017 to the Bank of the East, and the bank's discount rate is 12%. Because the note had been outstanding for 3 months before it is discounted to the bank, Stridewell first has to make a journal entry to record the accrued interest prior to that note being discounted. So that initial interest entry we see dated March 31st, 2017 will debit interest receivable $5,000 and will credit interest revenue $5,000. And that amount is calculated by taking the $200,000 note that was initially signed, and we'll multiply it by the 10% rate, and we'll multiply that 10% for 3 months. because it basically is covering the months of January, February, and March of 2017, because that's the date that Stridewell discounted it to the Bank of the East. So that 3/12 fraction in that expression gives the amount of $5,000. Next, we need to value the note. If it was held to maturity, how much would it be? And then we'll take the discount amount off of that to see what the cash proceeds are. So initially, we take the face amount of the note, and we're going to calculate how much interest would be on the maturity date for all 9 months. So we'll take the $200,000 note times 10% annual rate and 9/12 to represent the 9 months that the note is for. And that would calculate out to $15,000 interest due at the maturity of it. So we add them together, we have $215,000 maturity value. Now, the Bank of the East is going to discount that note at 12%. That's the bank's discount rate. And we're going to multiply that by the final 6 months of the note that the bank will hold it, because the first 3 months, Stridewell held it. So we're going to multiply the interest rate at 12%, the Bank of the East discount rate, times 6/12. And that calculates out to $12,900 discount. Subtract that off, and the amount of money that the Bank of the East is going to give Stridewell is $202,100. Now, similar to accounts receivable, Stridewell potentially could account for this transfer as a sale or a secured borrowing. In illustration 7-20 shows the journal entries to account for it as a sale without recourse. And to calculate the cash proceeds as it was determined above, you see the red amount that matches up with what we did of the calculation up above. You'll see the credit to the notes receivable, $200,000. The interest receivable is credited for $5,000 because that will get it off the books as well with the note receivable. And the difference then between that value and the $202,100 cash received is the loss on the sale of that note receivable to the Bank of the East, $2,900. I also have a little note over here on the right-hand side that walks you through that calculation to get to that difference, which is the loss of $2,900. Now, deciding whether to account for a transfer as a sale or a secured borrowing, transferors usually prefer the sale approach because it provides some advantages, as we'll see in illustration 7-21. Some of the things that the questions that are asked, whether you should, the transfer receivables should be accounted for either as a sale in the second column or a secured borrowing. You're going to ask yourself some questions. Does the accounting approach derecognize accounts receivable, reducing assets? If it does that, yes, then it is a sale. If it does not, then it is a secured borrowing. Why would the sale approach be preferred by the transferor? Because in this situation, the sale approach produces lower total assets and a higher return on assets, because you're removing assets from the balance sheet. You can go through these other situations as well, but what you'll see is every approach here under the sale column is beneficial to the transferor. The most critical element is the extent to which the company surrenders control over the assets. And the FASB's tried to provide some guidelines to constrain inappropriate use of the sale approach. Specifically, the transferor is determined to have surrender control over the receivables if and only if all these 3 conditions are met. Those 3 conditions here are mentioned ABC. The transferred assets have been isolated from the transferor, which is beyond the reach of the transferor and its creditors. Secondly, each transferee has the right to pledge or exchange the assets it received. And the third thing, the transferor does not maintain effective control over the transferred assets. If all those conditions are met, the transferor accounts for the transfer as a sale. If any of them are not met, then the transaction is recorded as a secured borrowing. Now, some companies have tried to circumvent these conditions by creating elaborate transactions to qualify for sale treatment. And Lehman Brothers' use of the repo 105 transaction, illustrated in 722, demonstrates how some companies have aggressively tried to get around the rules and regulations. Now, even though, as it says down here, that Lehman's interpretation was supported by GAAP, in effect at the time, these transactions were very poorly disclosed, and when they eventually came to light, the financial markets and investing public reacted very negatively. And because of that Lehman Brothers debacle, FASB has taken steps to close that loophole. Some additional information here on accounting for financial receivables. We see in illustration 723 a flow chart that gives us help with how to account for our financing, whether it be a transfer or a pledging. If it's a pledging of receivables, then you just simply make a disclosure, disclose the arrangement in a debt note. If it is a transfer, these are all conditions that we went through before up above. Does it meet the treatment, the three conditions for the sale? Then we record it as a sale and do those three items there. If it doesn't, then we record it as a secured borrowing and do the appropriate journal entries as we did up above. Now, disclosures. Transferors must provide information about the transfer so that users fully understand what's going on with the transfer and any continued involvement with the transferred assets and any ongoing risks to the transferor. So we have to make sure that we disclose all that information to the users of the financial statements. Now, the company also has to provide information about the quality of the transferred assets. Disclose the amount of receivables that are past due, any credit losses occurring during the period. And the company also must disclose how fair values were estimated, cash flows occurring between the transferor and the transferee, and any continued involvement in the transferred assets and how it will be accounted for. The last things that we need to discuss are some ratios here. The receivables turnover ratio and the average collection period. And these receivable turnover ratio is calculated by taking net sales and dividing it by the average accounts receivable net. And that net means you subtracted off the allowance for doubtful accounts. And to get the average, you'd start with the balance on January 1 and the balance on December 31, add the two together and average it. And what that turnover ratio will show you is the number of times during the period that the average accounts receivable balance is collected. Now, when we get that number, we're going to use that as the denominator into the average collection period ratio. The numerator is going to be 365 days. And what that's going to tell us is the approximate number of days that the average accounts receivable balance is outstanding. And so those are good numbers or ratios that financial analysts and users of the financial statements can use for their information analysis. To illustrate this, we have a couple of companies down below here, Symantec Corporation and CA Incorporated. And we see their financial data here for 2013-2012. And they have already calculated the receivables turnover and the average collection period. And we see on average that Symantec collects its receivables 52.07 days versus CA Incorporated at 69.13 days. They collect them about 17 days sooner, Symantec does. And then at 52.07 days for Symantec compared to 50.98 days for the industry average, it's about 1 day slower than the industry average. Now, we learned in Chapter 4 about earnings quality, and that some companies will try to manipulate reported income. And one of the things that you need to be careful about is that bad debt expense is one way, because it involves a discretionary accrual, that provides management with the opportunity to manipulate income. Sometimes financial statement users can examine the accounts receivables and the allowance of bad debts and other accounts to detect low earnings quality. The research has suggested that companies may manage their earnings by distorting fair value estimates that are made part of recorded securitizations. And some firms that are selling their accounts receivable will classify cash flows in the operating section of the statement of cash flows. Recent changes in GAAP have made it more difficult for transfers to qualify for sales accounting. So it's important that the accounting community be very cognizant of these type of transactions. I believe that will conclude what the lecture for Chapter 7. And hopefully it did record. I see I ran over. I'm about 30 minutes in, so hopefully it will publish.